Can you really live off dividends in 2025? Everyone loves the idea of passive income, money flowing in while you sleep. But when you look closer, most investors discover it's not as easy as YouTube makes it sound. With the S&P 500 yielding just around 1%, living entirely on dividends means you'd need serious capital or a smarter plan. In this explainer, we'll break down the real numbers, the realistic yields, and the portfolio strategies that can actually make dividend income sustainable. Welcome to Invest Education Hub, where we turn smart investing into simple decisions. Stay with us until the end, because this might be the most eye-opening dividend reality check you'll see all year.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
All right, let's just get right into this question, because it's really the core of the dream for so many of us, right? You see all the headlines about financial freedom and retiring early on dividends, and it sounds so easy. Just, buy some stocks, click the checks, and you're good to go. But the road from that dream to a reality you can actually live on, well, it's paved with some pretty hard numbers and some really critical decisions. It's not impossible, not by a long shot, but it means we've got to look past the hype and really get to grips with the main challenge. And here it is. This is that challenge boiled down to one single number: 1.1%. That's the dividend yield of the S&P 500, the 500 biggest companies in the US. Just let that sink in for a second. This isn't some obscure little index. This is the broad market that most people are invested in. And if you're looking for income, that's just not going to cut it. So what does 1.1% actually mean in the real world? Well, let's say you wanted a pretty modest income of, say, $40,000 a year from an S&P 500 fund. To get that, you would need to have, get ready for this, over $3.6 million invested. For most folks, that is a massive, almost impossible amount of money. And this just perfectly shows that the common advice to just buy the market is great for long-term growth, but it's a total non-starter for anyone who needs meaningful income today. We need a much more focused plan. So how do we build that smarter plan? Well, that's exactly what we're gonna do. Here's our game plan. First, we'll do a reality check and look beyond the S&P 500. Then, we're gonna get our hands dirty and actually build some sample portfolios. After that, we'll dive into the huge debate: dividend growth versus high yield. Then we'll cover the big mistakes you've got to avoid, and we'll wrap it all up with a simple, actionable playbook you can use. All right, let's kick things off with Section 1, the dividend reality check. This is all about facing the problem we just talked about, that the broad market isn't an income tool, and then figuring out what the real solution is for income investors. The answer isn't to just give up. It's to get way more specific. Instead of buying everything, we can use what are called dividend-focused ETFs. You've probably heard of some of them like SCHD, VYM, or VIG. Now, these aren't just a random pile of stocks. They're built with specific rules to find companies with healthy finances, a history of consistent dividend payments, and good cash flow. They're literally designed to give you a higher yield than the S&P 500, usually somewhere in that 2 to 4% range, because they only focus on the dividend pairs. But, and this is a really, really important but, there's no free lunch when you're investing. Ever. Getting a higher yield always comes with trade-offs. First, you might get slower overall growth. These are typically mature, stable companies, not the next explosive tech startup, so the stock price might not shoot up as fast. Second, you get sector concentration. A lot of these funds are packed with financials, utilities, and consumer goods companies. So if banks have a bad year, your portfolio is going to feel it. And finally, some high yield strategies can be a bit more volatile. The key is to know these trade-offs exist and manage them, not pretend they don't. All right, let's roll on to section 2 and see how all this stuff actually comes together in a real-world plan. This is where we get into the nitty-gritty, the actual math of how much you're going to need, and a few different model portfolios you can use as a jumping-off point. Okay, now this slide is where it gets really powerful because you can see how the yield directly impacts your goal. The formula is super simple. The capital you need is just your yearly income goal divided by your portfolio's yield. But look at the difference this makes. To get that same 40 grand a year, a 2% yield means you need $2 million. But jump up to a 3.8% yield, which is pretty typical for a fund like SCHD, and that number gets cut almost in half, down to just over $1 million. And if you can build a high-yield mix that gets you 5%, you're down to $800,000. That is the power of a focused income strategy. It brings that finish line so much closer. So what does a portfolio that actually does this look like? Okay, here's our first model, and this one is all about dividend growth. The engine here, the big 50% chunk, is in funds like VIG or DGRO. Their main job is to find companies that are increasing their dividend year after year. So the yield today might only be 2 or 3%, but the goal is for your income to grow, hopefully by 5 to 8% a year, beating inflation. This is really the most durable, long-term way to do it. It's for someone who wants a paycheck that gets bigger and bigger over time. Now, what if you need more cash flow today? Well, that brings us to the balanced income portfolio. Here, we're leaning more on a high-yield workhorse like SCHD. And you'll notice we're adding in a 10% slice of something like JPI, which is a covered call ETF. Now, these funds create a really high income stream by basically selling off some of their future growth potential. The result is a higher overall yield right now, maybe in that 3 to 4% range. This is great for someone who's maybe semi-retired or just wants to supplement their income. You're trading some long-term growth for more cash today. And our third model is this really flexible hybrid approach I like to call the paycheck plan. The whole idea here is you don't try to squeeze an unnaturally high yield out of your portfolio. Instead, you build a really solid core of dividend stocks that yields a sustainable 2.5 to 3.5%. Then, to get the rest of the income you need, you just sell a small, disciplined 1 or 2% of your capital each year. This gives you a total paycheck of 3.5% to 5.5%, but it lets your investments keep growing over the long haul. It's a really smart, modern way to think about retirement income. Okay, on to section 3. Now, we've tossed around the terms dividend growth and high yield, but the choice between them is probably one of the biggest strategic decisions you're going to make. I like to think of them as the foundation of your house and the accelerator in your car. This slide just lays out the difference perfectly. On the left, you've got dividend growth. It's all about quality and consistency. You're taking a lower yield today in exchange for a bigger, rising paycheck down the road. And these portfolios tend to hold up better when the market gets rocky. On the right, you've got high yield. This is all about getting the most income you can, right now. But that income growth is going to be slower, and you're taking on more of that sector risk we talked about. You know, the smartest move isn't really choosing one or the other. It's blending them. You use dividend growth as your solid foundation, and then you sprinkle in high yield like an accelerator to hit your income goals. And this quote, well, it really just gets to the absolute heart of it. Sustainability is everything. Chasing the biggest, flashiest yield without caring about the health of the company behind it is just a recipe for disaster. See, a dividend can get cut, and when that happens, your income just vanishes, and usually the stock price tanks with it. A sustainable, growing dividend, that's real income. A risky, super high yield that gets cut, that's just an illusion. Which brings us perfectly to our next section, the common mistakes investors make. Look, it's not enough to build the right portfolio. You also have to sidestep the traps, understand the taxes, and see right through the myths that can totally wreck your plan. First things first, taxes. Because let's be honest, it's not about what you earn, it's about what you get to keep. Most dividends you get from US stocks are called qualified, and they get taxed at those lower capital gains rates. But the payouts from things like REITs or those covered call funds are often non-qualified. That means they're taxed just like your regular income at a much higher rate. So what's the big takeaway? It's simple. Try to hold your most tax-inefficient, high-income funds inside a tax-advantaged account, like an IRA or a 401k. That way, the income can grow without you getting a big tax bill every year. Okay, time to bust myth number 1. And this one is so dangerous. We're all wired to be drawn to the biggest number, right? We see some ETF out there yielding 10%, 12%, maybe even more, and we think we've struck gold. This is probably the number 1 trap for new dividend investors. But here's the harsh reality. A crazy high yield is often a giant red flag. It can mean that the market thinks that company is in deep trouble and that a dividend cut is coming. When you chase these kinds of yields, you're not investing anymore. You're just gambling. And more often than not, it ends with that dividend getting slashed and your original investment shrinking as the stock price falls. We call that a yield trap. And that leads to myth number 2, which has gotten super popular lately with funds like JPI. The income they produce can feel like free money because those monthly checks are so high and so consistent. But again, it all comes back to the trade-off. Covered call strategies create that big income stream by selling away the potential for big gains. So when the market takes off like a rocket, these funds are going to get left behind because their growth is capped. And like we just talked about, their payouts are often taxed at that higher ordinary income rate. So yeah, they're a great tool for income, but they are not free money. They are a strategic choice with very clear costs. Whew. Okay, we have covered the reality, the math, the models, and the mistakes. So let's bring it all home with our final section, your Smart Investor Playbook. This is just a simple 4-step action plan to keep your dividend strategy running smoothly for the long haul. Here are the 4 disciplines. First, DRIP. That stands for Dividend Reinvestment Plan. Just set it and forget it. Automatically reinvest all your dividends to let your money compound like crazy until the day you actually need to spend it. Second, rebalance once a year. This makes you sell a little bit of what's done really well and buy what's lagging behind, keeping you on track. Third, review. You don't need to watch your portfolio every day, but once in a while, just check in and make sure your investments are still fundamentally healthy. And finally, keep cash. Having 1 year of your living expenses in a boring old savings account is your ultimate safety net. It means you will never, ever be forced to sell your stocks during a market crash just to pay the bills. And that really brings us to the final critical question you've got to ask yourself. This really sums up the whole strategy we've been talking about. Are you building a portfolio for the biggest possible cash flow today? Or are you building an income machine with the endurance to last and hopefully grow for decades to come? For most of us, the best answer is finding a smart balance right in between. Building wealth through dividends isn't about chasing the highest yield. It's about building consistency that lasts. If you can focus on balance, sustainability, and discipline, your income can grow stronger every year without putting your capital at risk. If this explainer helps you understand the truth about dividend investing, like it, subscribe, and share it with someone who dreams of living off their portfolio one day. Here at Invest Education Hub, we turn financial complexity into clarity, one smart decision at a time.